Marriott began as a root beer stand. That origin story is often told as a tale of entrepreneurship, grit, and expansion, but the more revealing story is institutional. Marriott did not simply grow larger. It evolved structurally from an operator of physical assets into a manager of brands, contracts, and fee streams. The transformation reflects a broader shift in how global hospitality works. In the early decades, Marriott was a traditional hotel company. Growth meant owning and operating properties. Capital was deployed into land, buildings, furnishings, and staff. Revenues rose and fell with occupancy, room rates, and local operating efficiency. This is an asset-heavy model. The balance sheet carries real estate. The income statement carries operating volatility. Capital requirements are high. Returns depend on both brand, strength, and property-level execution. That model works up to a point. As Marriott expanded, a constraint emerged. Owning hotels ties growth to capital. Each new property requires large upfront investment, local market risk, and long payback periods. Scaling globally under that structure is slow and balance sheet intensive. The institutional breakthrough came when Marriott began separating brand from building. Instead of owning every hotel, Marriott increasingly shifted toward management contracts and franchising. The company would supply the brand, reservation system, operating standards, training, and loyalty infrastructure. Local owners would supply the capital and take on the real estate risk. This was not merely a financing adjustment. It was a change in what Marriott actually sold. Under the new model, Marriott's primary product became system participation. Hotel owners pay Marriott fees to operate under its brands. Those fees are often tied to revenue, not profit. Management fees may include base fees as a percentage of gross revenue and incentive fees based on operating performance. Franchise fees include royalties and contributions to marketing and loyalty programs. The key is that these payments flow regardless of property ownership. This converts Marriott from an asset owner into a fee collector. From an institutional perspective, this changes everything. Capital intensity falls. Growth accelerates because Marriott no longer needs to fund construction. Risk shifts to property owners. Cash flows become more predictable because they are diversified across thousands of hotels and tied to top-line performance. The corporation becomes lighter on assets and heavier on contracts. This is often described as an asset-light strategy. But that phrase understates the shift. Marriott did not become less powerful. It became differently powerful. Brand became the core asset. The value of Marriott now rests in its portfolio of brands ranging from luxury to select service, and in the systems that make those brands commercially viable. Reservation platforms, global sales networks, marketing reach, and especially loyalty programs became the infrastructure that binds the system together. Loyalty programs are not marketing tools alone. They are demand allocation systems. When millions of travelers are enrolled in a loyalty network, their preferences can be steered. Points, tiers, and perks channel demand toward affiliated properties. This increases occupancy and pricing power across the network, which strengthens the value of Marriott's brand to hotel owners. Owners pay for that demand access. Seen through this lens, Marriott resembles a platform company more than a landlord. It does not primarily sell rooms to travelers. It sells brand affiliation, distribution, and operating standards to property owners. Travelers matter, but the long-term contractual relationship is with the hotel owner who signs a management or franchise agreement. This relationship is structured to preserve Marriott's control. Brand standards are enforced globally. Renovation cycles are mandated. Technology systems are required. Loyalty participation is integrated. Pricing strategies are influenced by central system. The owner controls the building, but Marriott governs the brand experience. This creates a layered governance structure. At the property level, owners manage staff, maintenance, and local costs. At the brand level, Marriott controls positioning, standards, and distribution. The contract allocates authority between these layers, but it is rarely an equal partnership. Marriott's evolution mirrors broader trends in capitalism. Companies increasingly separate intellectual and organizational capital from physical assets. Ownership becomes less important than control over standards, data, and distribution channels. Marriott's balance sheet reflects this. Fewer owned hotels, more managed and franchised properties, revenue increasingly derived from fees rather than direct operating margins. The result is resilience. When travel demand falls, Marriott's fee income declines. but it does not carry the same property-level losses as an owner-operator. When demand rises, it benefits from system-wide revenue growth without needing to build every room itself. Risk is distributed across owners. Brand value is centralized. This also explains Marriott's acquisition strategy. Purchasing brands and portfolios expands the system. Each added brand increases network density, loyalty program, attractiveness, and negotiating leverage with online travel agencies and corporate clients. Scale enhances the platform effect. The larger the network, the more valuable participation becomes for both owners and travelers. That value reinforces Marriott's ability to collect fees. From a historical perspective, Marriott did not abandon hospitality. It redefined where hospitality value sits. The company moved from running hotels to orchestrating a global ecosystem of properties connected through brand, technology, and loyalty infrastructure. The hotel building became the interface. The contract became the business. This is the institutional evolution of Marriott, from a root beer stand selling products directly to a global platform monetizing participation in a branded, standardized, and data-integrated hospitality system. The rooms are visible. The fee architecture is decisive. For continued institutional analysis of how companies evolve from operators to system managers, subscribe.